Treasury Liquidity. Just broke, Fed's emergency. Pivot went live overnight. Most people woke up yesterday completely unaware. The financial system's plumbing, the invisible foundation that holds every bank, every bond, every business transaction together, just cracked. Not loudly, not on the news, silently. The Federal Reserve responded in darkness. An emergency facility activated. No press conference, no explanation, no warning. Within 48 hours, the machine that prices risk for the entire global economy was on life support. And if you're running a business, managing capital, or building anything in this economy, what happened in those 48 hours will determine whether you survive what comes next. Welcome to Silver Radar. Now, before we go any further into what just broke in the financial system, I need to ask you something important. If you've been in business long enough, if you've seen a few cycles, if you remember when a handshake meant something and financial news actually meant something too, then you know that the truth doesn't come easy anymore. It gets buried. So here's what I'm asking you to do, not as a favor, but as a fellow person who believes information this critical shouldn't stay hidden. Hit that subscribe button. Think of it like this. You wouldn't walk into a negotiation without knowing what the other side knows, would you? This channel is your edge. And one more thing. Drop a comment below and tell us, where are you watching this from? Are you in the States, Europe, Asia, South America? Because what's happening right now, it's not just an American problem, it's global. And I want to know, where in the world are people waking up to this? Now, let's get into what actually happened. On the evening of January 22nd, 2025, something broke. Not in the headlines, not on cable news, not in the morning briefings that most executives scan over coffee. It broke in the Treasury market. The United States Treasury market, the single most important financial market on Earth, experienced what technicians call a liquidity event. But that term, liquidity event, sanitizes what actually happened. What actually happened was this. The market that underpins every mortgage rate, every corporate bond, every pension fund, every central bank reserve in the global system, seized. For a brief window, buyers vanished, sellers couldn't exit. Prices didn't just move, they gapped. And in those gaps, in that silence between the bid and the ask, the Federal Reserve saw something that made them act faster than they have in years. By the morning of January 23rd, an emergency facility was live. No announcement. No Powell press conference. No carefully worded statement about monitoring conditions. Just activation. Now, let's be very clear about what Treasury liquidity actually means, because this isn't abstract. Liquidity, in its simplest form, is the ability to convert an asset into cash without moving its price. U.S. Treasury securities, bonds issued by the federal government, are supposed to be the most liquid assets in existence. They are the benchmark. They are what every other asset gets priced against. When a corporation wants to issue debt, they look at Treasury yields and add a spread. When a bank calculates risk, Treasuries are the starting point. When foreign governments hold reserves, they hold Treasuries. The entire architecture of modern finance rests on the assumption that you can always buy or sell a Treasury bond at a fair price. Always. But on January 22nd, that assumption failed. The technical indicators told the story before anyone admitted it publicly. Bid-ask spreads, the gap between what buyers will pay and sellers will accept, widened beyond normal ranges. In some maturities, particularly the 10-year note, spreads blew out to levels not seen since March 2020. Market depth. The volume of orders sitting on either side of the current price collapsed. What that means in practical terms, a large institution trying to sell $50 million in treasuries would have moved the price against themselves significantly. That's not liquidity. That's fragility. Settlement failures, instances where transactions don't complete on time, spiked. And here's what makes this different from past crises. In 2008, the problem was credit risk. Banks didn't trust each other's solvency. In 2020, the problem was a liquidity scramble. Everyone wanted cash simultaneously because the economy shut down. This time, the problem is structural. The market itself, the plumbing, cannot handle the volume and velocity of transactions that the current fiscal and monetary environment demands. And the Federal Reserve knows it. That's why they move so fast. The facility they activated, likely an expansion of the standing repo facility or a similar mechanism, does one thing. It allows primary dealers and major institutions to exchange treasuries for cash immediately, using the Fed as the counterparty. It's a backstop, a tourniquet. It stops the bleeding, but it doesn't heal the wound. And here's the part that should concern every person watching this who operates in the real economy. When the Fed acts this quickly, without public debate, without the usual multi-week deliberation process, it means they saw contagion risk. It means they calculated that if the Treasury market seized for even 24 more hours, the damage would spread. Corporate bond markets would freeze. Credit lines would tighten. Businesses that rely on rolling over short-term debt would face funding crises. The machine would stop. So they turned the emergency switch, and most people never even noticed. But institutional players noticed. The professionals, the people who manage billions, who sit in trading desks in New York and London and Singapore, they saw it immediately, and they adjusted. They pulled risk off the table, they repositioned portfolios, they made the moves that protect capital when the foundation shifts. And now, the question isn't whether the Treasury market experienced stress. That's confirmed. The question is, why did it happen now? What forces converged to break the most liquid market in the world? And what does the Fed's emergency response tell us about what they know that we don't? Because when the plumbing breaks, you don't just fix the pipe. You ask, what pressure built up behind it? There's a concept in engineering called resonant frequency collapse. It's what happens when multiple vibrations, each one harmless on its own, align at exactly the wrong moment and bring down a structure that was supposed to be indestructible. The Tacoma Narrows Bridge in 1940 twisted itself apart not because of a hurricane, but because wind vibrations matched the bridge's natural frequency. What happened to Treasury market liquidity follows the same physics. 3 separate pressure systems, each building independently, converged at a single point in time, and the structure couldn't hold. Let's dissect them. Pressure system. 1. The Great Unwind. Since June 2022, the Federal Reserve has been engaged in something called quantitative tightening, QT for short. But that phrase, that bureaucratic acronym, hides what's actually happening. The Fed is removing money from the system. During the pandemic, and during the financial crisis before that, the Fed purchased trillions of dollars in Treasury securities and mortgage-backed securities. They did this to inject liquidity, to keep markets functioning, to prevent collapse. But now, they're doing the reverse. Every month, billions of dollars in treasuries mature on the Fed's balance sheet. And instead of reinvesting that money, buying new treasuries to replace the old ones, they let it disappear. Poof, gone. The Fed's balance sheet has shrunk from nearly $9 trillion at its peak to just over $7 trillion today. That's $2 trillion extracted from the financial system. Now here's the part most people miss. When the Fed owned those treasuries, they weren't being traded. They were locked away, removed from circulation, which meant less supply in the market, which meant higher liquidity. But as QT accelerates, those treasuries come back into circulation. Dealers have to absorb them. Banks have to hold them. Investors have to buy them. And there's a limit, a hard limit, to how much the private sector can absorb before the machine jams. We just hit that limit. Bank reserves, the cash that financial institutions hold at the Federal Reserve, have dropped below levels that analysts consider comfortable. When reserves get too low, banks become reluctant to lend. Dealers become reluctant to take inventory. Liquidity evaporates. The Fed has been draining the pool, and now we're scraping the bottom. Pressure system. 2. The issuance avalanche. While the Fed was pulling liquidity out, the U.S. Treasury was dumping supply in. The federal government is currently running a deficit of approximately $1.8 trillion annually. That's not political commentary. That's arithmetic. To fund that deficit, the Treasury Department has to issue new debt, lots of it. In 2024 alone, the Treasury issued over $2 trillion in new securities. And in 2025, the pace hasn't slowed. Every week, there are auctions. 2-year notes, 5-year notes, 10-year notes, 30-year bonds, wave after wave of new supply, and someone has to buy it. Primary dealers, the banks authorized to participate in Treasury auctions, are required to bid, but their balance sheets aren't infinite. Post-2008 regulations, specifically the supplementary leverage ratio, limit how much inventory banks can carry. It's a safety rule, designed to prevent another Lehman Brothers. But it has a side effect. It reduces the capacity of the financial system to absorb Treasury supply. So when issuance surges and dealer capacity is constrained, and the Fed is simultaneously pulling liquidity out through QT, you get a mismatch. Too much supply, not enough demand, not enough balance sheet space. And when supply overwhelms demand, prices fall and liquidity breaks, foreign buyers, traditionally a key source of Treasury demand, have pulled back. China has reduced its holdings. Japan's Treasury purchases have slowed as they manage their own currency crisis. The burden has shifted to domestic institutions, and they're struggling to carry the weight. Pressure system 3, the fragmented market structure. Here's the third pressure point, and it's the one almost no one talks about. The Treasury market, for all its importance, is not a centralized exchange. It's an over-the-counter market. That means trades happen between institutions, through dealers. often on electronic platforms that operate in fragments. After 2008, regulators pushed for more transparency, more electronic trading, more automation. The intention was good: make markets safer, reduce counterparty risk. But automation has a weakness. When stress hits, algorithms pull back. High-frequency traders, who provide liquidity in calm times, vanish in volatile times. Their risk models say, stop trading, and they do, instantly. So the market that was liquid 5 minutes ago becomes illiquid in seconds. Human market makers, traders who used to step in and provide a bid during chaos, have been replaced by machines that step out. And when machines step out simultaneously, you get what happened on January 22nd, a void. No buyers, no liquidity, just air. Now, here's why this matters. These three systems didn't cause the crisis individually. QT alone wouldn't have broken the market. Issuance alone wouldn't have broken it. Fragmented structure alone wouldn't have broken it. But together, at the same moment, they created a resonance, and the structure collapsed. The Fed saw it coming, maybe hours before it fully materialized, and they acted. But their action, the emergency facility, is a temporary patch. It doesn't fix QT. It doesn't reduce issuance. It doesn't restructure the market. It just stops the collapse from spreading, for now. There's an old rule in emergency medicine. When a trauma patient arrives, and the doctor doesn't ask questions, doesn't run tests, doesn't consult, but immediately cuts open the chest and starts manual compressions, that tells you everything. The patient is dying. Right now, on January 23rd, 2025, the Federal Reserve performed the financial equivalent of emergency surgery. No consultation. No public debate, no carefully staged press conference with Jerome Powell explaining the rationale behind measured policy adjustments. They just acted. And if you understand what that means, if you read the silence correctly, it should fundamentally change how you think about the system we're operating in. The mechanism, what actually happened. The facility the Fed activated isn't new. It's called the Standing Repo Facility, or SRF. It was created in July 2021 as a permanent backstop, a tool designed to prevent exactly the kind of liquidity crisis we just saw. Here's how it works. Eligible institutions, primarily banks and primary dealers, can approach the Fed and exchange Treasury securities for cash overnight at a fixed rate, no questions asked. Think of it like a pawn shop for the financial system. You bring in your collateral, Treasuries in this case, and you walk out with cash immediately. The next day, you return the cash, pay a small interest rate, and get your collateral back. It's designed to be a release valve. When liquidity dries up in the private market, when dealers can't find buyers, when cash becomes scarce, the Fed becomes the buyer of last resort. But here's what changed on January 23rd. The usage of that facility spiked, not just a little, dramatically. Institutions that normally wouldn't touch the SRF, that would consider it a sign of weakness to access emergency Fed funding, lined up because they had no choice. The private market had frozen. And without access to that Fed backstop, some of those institutions would have faced a funding crisis by the end of the day. That's not speculation. That's what the data shows. Repo rates, the cost of borrowing cash overnight using treasuries as collateral, had spiked above the Fed's policy rate. That's not supposed to happen. It's a market dislocation, a breakdown in normal pricing relationships. And it signals one thing: desperation for cash. Historical context: why this time is different. The Fed has intervened before, September 2019. The repo market seized. Rates spiked above 10%. The Fed stepped in, injected hundreds of billions, and stabilized the system within days. March 2020, pandemic panic, everyone wanted cash simultaneously. The Fed launched emergency lending programs, bought assets at unprecedented scale, and prevented total collapse. But both of those events had clear external triggers. In 2019, it was a coincidence of corporate tax payments and Treasury settlement dates draining reserves. In 2020, it was a global pandemic shutting down the economy. This time, there's no obvious external shock, no pandemic, no Lehman-style bankruptcy, no geopolitical explosion, just the system itself, under normal operating conditions, breaking. And that's what makes this terrifying. Because if the Treasury market can't function under current conditions, what happens when something actually goes wrong? What happens when there is a shock? The silence. Why no announcement? Here's the question that should be keeping financial professionals awake. Why didn't the Fed announce this? Why no emergency statement? Why no press briefing explaining that they had taken action to stabilize markets? There are two possible answers. Answer one: they didn't want to cause panic. If Jerome Powell had gone on television and said, "We've activated emergency facilities because Treasury market liquidity broke," Markets would have spiraled. Investors would have dumped risk assets. The headline would have been, Fed admits crisis. So they stayed quiet. They fixed the plumbing and hoped no one would notice the repair crew in the basement. Answer 2. They know this isn't over. Perhaps the Fed didn't announce the intervention because they know they'll need to do it again and again. If this is the new normal, if Treasury market stress is now a recurring feature rather than a one-time event, then announcing it would be admitting that the system is fundamentally unstable. That's not a message central banks want to send, so they operate in shadows. They stabilize quietly. And they hope the public keeps trusting that everything is fine. What the Fed's action reveals about risk assessment. The speed of the response tells us something critical. The Federal Reserve has access to data we don't see. Real-time settlement flows, dealer balance sheet positions, collateral valuations across the entire banking system. And when they looked at the data on January 22nd, they saw contagion risk. They saw that if the Treasury market stayed frozen for another 24 hours, the stress would spread to corporate bond markets, to mortgage-backed securities, to money market funds, to the commercial paper market that funds corporate payrolls. When the chains of dependency in modern finance are invisible until they break, and the Fed saw those chains starting to snap. So they intervened, not because they wanted to, but because the alternative was watching the funding markets for the entire economy seize up. The moral hazard trap. But here's the problem with emergency interventions. They work, they stop the crisis, but they also create dependency. If markets know the Fed will step in every time liquidity breaks, then markets take more risk. They operate closer to the edge. They assume the backstop will always be there, and that makes the system more fragile, not less. It's called moral hazard. The insurance creates the behavior that requires the insurance, and we're trapped in it. The Fed can't let the Treasury market break because the consequences are catastrophic. But by preventing it from breaking, they enable the conditions that make it fragile. It's a loop, and we just went another rotation deeper into it. Market response. The 48-hour window. In the 48 hours after the intervention, Treasury yields stabilized, bid-ask spreads narrowed, repo rates came back down, the machine started working again. But volatility didn't disappear. Equity markets wobbled. The dollar strengthened as foreign investors sought safety, credit spreads widened slightly, a signal that corporate debt markets were repricing risk, and the professionals, the people who manage institutional capital, started asking the question that matters. If the Fed had to intervene this time, when will they have to intervene next time, and the time after that? And what happens when the interventions stop working? Let's forget the academic debates about monetary policy, the political arguments about deficits, the technical discussions about market structure. None of that matters if you're running a business. What matters is this: the financial system you rely on just proved it's more fragile than advertised. And fragility? In the machinery that determines your cost of capital, your access to credit, your ability to manage cash flow, that's not background noise. That's a direct threat to operational survival. So the question isn't whether the Treasury market will experience stress again. It will. The question is, what do you do about it? Risk assessment layer, understanding your exposure. Most business leaders don't think about Treasury markets. Why would they? They're not trading bonds. They're selling products, managing teams, trying to hit quarterly targets. But Treasury market instability touches every business. Whether you see it or not, here's how. Transmission channel. 1. Credit conditions. When Treasury yields spike, or when liquidity dries up, banks tighten lending standards, not because they want to, because their own funding costs rise, because their risk models flag uncertainty, because regulators start asking questions. And when banks tighten, credit lines shrink. The business that was planning to draw on a revolver to fund inventory suddenly finds the terms changed. The manufacturer negotiating equipment financing discovers rates just jumped 50 basis points. The real estate developer rolling over construction debt gets told the bank needs more collateral. Treasury stress doesn't stay in the Treasury market. It bleeds into commercial lending within days. Transmission channel 2. Interest rate volatility. Businesses plan around stable interest rate environments. You model cash flows, you project debt service costs, you make capital allocation decisions based on assumptions about what borrowing will cost over the next 3 to 5 years. But when Treasury markets become unstable, those assumptions break. Rates don't move gradually, they gap. A company with floating rate debt suddenly sees monthly interest expenses jump 20%. A business planning a bond issuance watches the window close as spreads widen. Volatility kills predictability. And without predictability, you can't plan. Transmission channel 3. Currency and trade finance. For businesses operating internationally, Treasury market stress creates currency chaos. When the dollar strengthens rapidly, as it did in the 48 hours after the Fed's intervention, import costs change, export competitiveness shifts, hedging strategies that were working stop working, and trade finance, the short-term credit that enables international supply chains, tightens. Letters of credit become more expensive, documentary collections slow down, cash conversion cycles extend. A business that operates smoothly when financial plumbing works suddenly finds itself waiting weeks for payments to clear. Transmission channel 4, capital availability, private equity firms, venture capital funds, institutional investors, all of them price risk off the Treasury curve. When that curve becomes unstable, when liquidity breaks, they pull back. Fundraising slows, deal flow drops, exit valuations compress. A business that was planning a growth capital raise finds investors suddenly cautious. A company preparing for acquisition discovers buyers want steep discounts to compensate for uncertainty. Capital doesn't disappear, but it becomes expensive and selective. Operational decision. Matrix. What to do now? So what does a rational business leader do with this information? Not panic, not freeze, but adjust. Here's the framework. Decision point 1. Cash management. Cash is no longer just working capital. It's insurance. In an environment where credit can tighten overnight, where funding markets can freeze without warning, liquidity buffers matter more than optimization. That means maintaining higher cash reserves than financial models suggest is optimal. Diversifying banking relationships, so no single institution holds all your operating accounts. Keeping credit lines open and periodically drawn, even if you don't need the cash, to maintain the relationships and ensure availability. Avoiding the trap of excess leverage during periods of apparent calm. The businesses that survive liquidity crises are the ones that entered them with cash. Decision point 2, debt structure and refinancing. If your business carries debt, and most do, the structure of that debt just became more important than the cost. Fixed rate debt locks in certainty. Floating rate debt exposes you to volatility. In a stable environment, floating can be cheaper. In an unstable environment, fixed is survival. If you have near-term maturities, debt rolling over in the next 12 to 18 months, refinance now, not later, not when rates look better. Now, because when Treasury markets seize, corporate debt markets freeze, and the window to refinance closes. Decision point 3, capital allocation under uncertainty. Every investment decision, every expansion plan, every acquisition now carries an additional risk variable. How does this project perform? If credit tightens, if interest rates spike, if funding markets freeze, the projects that made sense at 3% borrowing costs may not make sense at 6%. The expansion that required a revolving credit facility may not be viable if that facility becomes unavailable. Run stress scenarios, model the downside cases, and be willing to delay or cancel projects that only work in stable environments. Because stable is not what we have. Decision point 4, supply chain and vendor finance. Supply chain disruptions aren't always about physical shortages. Sometimes they're about financial breakdowns. When credit tightens, smaller suppliers struggle first. They can't access working capital. They can't finance inventory. They delay shipments or they disappear entirely. If your business depends on a complex supply chain, audit the financial health of critical vendors. Understand their leverage. Know who's exposed to rollover risk and build redundancy. Not just alternative suppliers, but alternative payment structures. Consider offering early payment discounts or extending purchase order financing. The cost of keeping a supplier solvent is far lower than the cost of replacing them in a crisis. Scenario planning requirements, mapping multiple futures. No one knows how this unfolds. Not the Fed, not Treasury officials, not the smartest economists or the most connected traders. So planning for a single outcome is planning to fail. Instead, map 3 scenarios. Scenario 1, stabilization. The Fed's intervention works, Treasury markets calm, liquidity returns, QT slows or pauses, issuance gets absorbed without further stress. In this scenario, business conditions remain challenging but manageable. Credit stays available, rates stabilize, growth continues slowly. Scenario 2, recurring stress. What happened in January happens again in March and again in June. The Fed intervenes each time. Markets lurch from crisis to stabilization and back. Volatility becomes the norm. In this scenario, businesses face persistent uncertainty. Credit conditions tighten periodically, planning horizons shorten, conservative positioning becomes mandatory. Scenario 3, systemic restructuring. The Treasury market breaks, and this time the Fed's tools don't work. Or they work, but create unintended consequences that cascade elsewhere. currency crises, sovereign debt concerns, forced policy shifts. In this scenario, the rules change. Fiscal dominance, yield curve control, capital controls. Businesses face a fundamentally different operating environment. You can't predict which scenario happens, but you can position to survive all three. And positioning means prioritizing resilience over optimization. The strategic imperative, signal versus noise. Here's the final point. The hardest part of navigating instability isn't understanding the technical details, it's distinguishing signal from noise. Every day, there will be headlines, market moves, Fed statements, analyst predictions. 90% of it is noise, but 10% is signal. The challenge is knowing which is which. Here's a simple filter. Watch what central banks do, not what they say. The Fed activated an emergency facility without announcing it. That's signal. Watch leading indicators, not lagging headlines. Repo rates, dealer balance sheets, Treasury auction bid-to-cover ratios. Those tell you stress is building before it breaks. Watch institutional behavior, not retail sentiment. When sovereign wealth funds shift allocations, when pension funds adjust duration, when primary dealers reduce inventory, that's professionals repositioning for risk. Follow the smart money, not the loud money. Final assessment, the phase transition. What happened on January 22nd and 23rd, 2025, was not an anomaly. It was a signal, a marker, a threshold crossed. The financial system, the machinery that prices risk, allocates capital, and enables commerce, just proved it cannot handle current structural conditions without emergency support. And emergency support is not a business model, it's a delay tactic. For business leaders, the implication is clear. The era of assuming financial stability is over. The era of building resilience into every decision has begun. The companies that recognize this and adapt will survive what comes next. The ones that don't, won't.